we're going to be talking about absorption versus variable costing. In order to do this, we're going to be looking at a short example. Cheryl Corporation produces one product. Currently, their sales price is $15 per unit. Their variable cost includes selling, general, and administration of $2 per unit, production cost of $4 per unit, and their fixed cost, selling, general, and administration, $14,000 for the entire year, and production, $20,000 for the entire year. Under absorption costing, we're going to put together a normal GAAP income statement using this information. So, end of the first year, see how Shell Corporation did. Let's assume during their first year of production, they manufactured and sold 3,800 units. So they manufactured and sold exactly what they, the exact same number. So an absorption costing income statement is the one you should be familiar with, a normal GAAP income statement. You have sales, less cost of goods sold to get you gross profit, less the operating expenses, both variable and fixed, get you pre-tax income. We're going to ignore income tax effects at this point in time. So we start with sales. They sold 3,800 units at $15 per unit. That will give them sales revenue of $5,700. Now what about cost of goods sold? Let's talk about cost of goods sold for a second. Cost of goods sold is simply the production cost of sold units. So it's only taking the production cost and we finally expense them when the units are sold. So we're looking for what of that production cost was related to the units that were actually sold. Well, in this case, we have variable production cost of $4 per unit. We produced and sold 3,800 units, so that's $15,200. Fixed cost for the entire year of $20,000 gives us total production cost of $35,200. So if we were looking at T accounts, right now the $35,200 and finished goods inventory, we would have $35,200. What we're trying to figure out then is what portion of that $35,200 went to cost of goods sold. Well, since we produced and sold 3,800 units, all $35,200 is transferred to cost of goods sold. We have $35,200 as our cost of goods sold, which gives us a gross profit of $21,800. From there, then we look at the operating expenses. Operating expenses are period costs. They're recognized in the period that they're incurred. So we had variable SG&A of $2 per unit. We have 3,800 units sold, so $7,600. And then we had the fixed SG&A of $14,000 to give us income of $200. Okay. So under absorption costing, we're separating out the production costs and the period expenses, the selling, general, and administration expenses, which are recognized in the period they're incurred. Cost of goods sold is simply the production cost of the units sold. So when we produce and sell 3,800 units, the income is $200. Now let's change it up a bit. What happens when, instead of manufacturing and selling 3,800 units, actually have a little bit of inventory left over at the end of the year. What happens if they manufacture 5,000 units but only sell 3,800 units? Well, our sales will be the same. Sales are still 3,800 units, $15 per unit, so $5,700. And remember, cost of goods sold is simply the cost of the goods sold. So we're only looking at the cost of these 3,800 units. The entire production cost is related to these 5,000 units. So what happens then? How do we calculate cost of goods sold? We'll change this up a bit. Our variable cost now what is going to be in this finished goods inventory account? Well, we produced 5,000 units at $4 each, and we still had the fixed cost. So we have 20,000 of variable cost. We still have 20,000 of fixed production cost. So we have 40,000 total production cost sitting in the finished goods inventory account. We're trying to figure out the cost of goods sold amount. So the cost of the goods sold, well, we only sold 3,800 units. Well, this 40,000 is related to 5,000 units. So that means that if we spread this $40,000 over $5,000 or 5,000 units, that's $8 per unit. So when $8 per unit, 3,800 units are coming out of finished goods, going into cost of goods sold. 8 times 3,800 is 30,400. So we have cost of goods sold of 30,400. Which gives us gross profit of 26,600. So I have our operating expenses, $2 per unit variable, times the 3,800 units sold, 7,600, and then the 14,000 fixed. Gives us income of 5,000. This point, you should be thinking, wait a second. Just a while ago, when we sold 3,800 units, we had income of 200. Now when we sell 3,800 units, we have income of 5,000. None of our backing facts have changed. The only thing that changed was that we now are manufacturing 5,000 units instead of 3,800. So we have inventory. So why this income difference? It all is in this cost of goods sold number, which further we can see is all because of this fixed cost. What's happening is, yes, With the variable cost, we're still going to have some of that unfinished goods inventory, but for both situations, when we sell 3,800 units, we're recognizing $4 of expense per unit. When we have the fixed cost here though, when we manufacture 5,000 units, this 20,000 gets spread out over 5,000 units versus being spread out over 3,800 units. So fixed cost, as we increase the units, the cost per unit goes down. So when we sell less than we make, some of that fixed cost remains in finished goods inventory rather than flowing through cost of goods sold. So we can see we'd have higher net income. Now, yes, this could be a manipulation to increase income by manufacturing too many units. Now, the problem is, as you go along, eventually that will catch back up to you. You got to store those excess inventory, which will increase cost, as well as the possibility of never being able to sell excess inventory. If it's simply the fact that we're trying to build up a little bit of inventory for next year's sales increases that we're expecting, then we'll see a reverse of this situation once we manufacture fewer items than we sell. So absorption costing. It's for externally accounting purposes. We have an income statement such as this. GAAP rules require us to only recognize production costs when the units are sold. And we recognize them as cost of goods sold. Now internally, we don't want to be looking at a manufacturing unit that says, hey, if I just produce more units than we have sales for, I can increase what I'm being evaluated on. Maybe it's gross profit. I can increase gross profit. Internally, we do not want those decisions to be made like that. So instead of looking at absorption costing, we look at something called variable costing. Variable costing is for internal purposes only. And as the name implies, we're going to be focused on variable cost, separating from the fixed cost. It does not mean that we stop and just look at the variable cost. It just means we're separating them out from the fixed cost. So how that income statement looks, we still look at sales. Then we're going to look at the variable cost, which will give us contribution margin. Then we'll look at fixed cost to get income. The variable costing income statement is also known as the contribution margin income statement because we have the contribution margin there. It does not stop at contribution margin. It's just a major focus of the income statement. So let's look at it under this situation of manufacturing 5,000 units but selling 3,800. Again, our sales, under all situations, we're selling 3,800 units at $15 per unit, so that's always going to stay the same. So 57,000. Variable cost. Under variable costing, we're going to stick all the variable costs together. This means both the production plus the the selling, general, and administrative expenses. So in this case, we had $4 for production plus $2 for SG&A, so $6 per unit. 3,800 units means we'll have a cost of $22,800. This gives us a contribution margin of $34,200. Our fixed cost, again, we're grouping all the fixed costs together. Again, production and SG&A. We have $20,000 for production, $14,000 for SG&A. Together, that's $3,400. Our income is $200. The income under the variable costing income statement of $200 is the same as the absorption costing income statement when we produced and sold $3,800. So the difference between the variable costing statement, where the income is $200, and the absorption when we manufactured 5,000 units versus sold 3,800, where it was a 5,000 income. This difference of 4,800 is that difference in fixed cost. Show that better. Remember, the fixed cost was $20,000. We produced 5,000 units, so that was $4 per unit. Produced 5,000, sold 3,800, 1,200 units is the difference, times $4 per unit, gets us to that $4,800 difference. It's going to be on the balance sheet as inventory. So the difference between absorption costing and variable costing, the income is going to be when we manufacture more units than we sold, we're going to have a higher income under absorption costing due to the fixed cost being absorbed by the units that are not sold. When we manufacture less than we sell, we'll just have the flip of this. Our income statement under variable costing will be higher than our absorption costing. So I hope now you better understand absorption versus variable costing. You can go forward with some of these concepts. The variable costing, very important internally, managerial accounting and cost accounting. Going forward, this will be often used to calculate and make other decisions. Thank you.